Morning, good morning, good morning. We got a lot of light in there to the back. Guess I gotta pull that. Oh yeah, I had the curtains open and the clip that normally keeps the all the light out. I guess I didn't put back one there, so we got some seeping in, but that's all right. Ain't nothing wrong with a little bright future peeking through the blinds. Welcome everybody. Good morning. Hope you had a great morning. Back out on the running trail for me this morning. Took a break yesterday. Foot was giving me a little bit of trouble, but we're back on the horse today. Consistency, that's the key, just like being here for our pre-market sessions. Speaking of which, these sessions, we go over the important news, notes, and analysis that are key to making sure that you are multiplying your money in markets more often than you're not. And yeah, being here and being consistent is a big part of the game. So let's go ahead and dive into things. We're here for one thing and one thing only, and that's to get 1% better. Right. So make sure you state your intention to do that. You declare that, you put it out right into the universe. You put it out, you make it publicly declared, and you get that same energy reciprocated back to you. So make sure that whether you're watching live or via replay, you throw those ones in the chat. And I'm going to go ahead and dive into what we got going on this morning so that I can then get through this and get to the analysis and the fun stuff. So our top news here, is it transitory? The much awaited Fed pivot has materialized, but it's not what investors have been expecting. The change was supposed to signal that the central bank finally reversed course on its contractionary monetary policy path, which has been in place since March 2022. It would have come after Powell and Co. continued to telegraph that rate cuts were soon in the cards, but policymakers are now formally taking a step back from those forecasts following 3 consecutive months of stronger than expected inflation readings. Quote, the recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence, Fed Chair Jay Powell said at the Wilson Center in Washington, D.C. Now, quote, last year, rebounding supply supported U.S. growth in spending and also employment alongside a considerable decline in inflation. The more recent data show solid growth and continued strength in the labor market, but also a lack of further progress so far this year on returning to our 2% inflation goal. So we saw that rapid progress in inflation decreasing, and I feel like it spread a lot of optimism. And then now we're struggling at that last push, which they did say would be the toughest, right? That last leg, always the hardest. Just they're saying here, many have predicted that the last mile of the inflation fight would be the hardest, and the latest comments didn't rock equities too hard, as the central bank has been clear that incoming data would determine its path forward. Suffice it to say, things will be higher for longer, but for the time being, the next rate move is still forecasted to be a cut. Things could get rocky if that stance ends up shifting to a hike, which could happen if price pressures resurface and put a so-called soft landing into doubt. So the data comes in and we have to adjust our expectations as such, right? When we have data that comes in and it is not one hot read, two hot reads, but three hot reads on inflation, it's not going down at the rate at which we need it to go down for the Fed to be comfortable, then we have to adjust our expectations as well. Right. So that starts to shift not everything that's been happening, but shift our thought process when it comes to, okay, what are our expectations here for the year? I think that while it was very probable in the past that we had rate cuts sooner rather than later, now that was when everything was looking good and on track, right? But now we've got inflation creeping back up, and it's something that we can't ignore. So that doesn't really, too boldly change my stance on a lot of things other than maybe the commercial real estate sector, because that is something that is really suffering because of the rates. So if the rates do drop, then that sector runs. But I feel like without that, real estate and commercial real estate can continue to struggle. So that's probably my biggest, kind of pivot in terms of ideology with this news. We'll see how that manifests, in the form of this price action for banks. But as of right now, banks are doing well. They're knocking earnings out of the park. And banks have been doing really well this year. So I'll watch for that, but I'm not going to like abandon banks because I didn't solely get into banks because of these rates going down, right? That would be something that really helps banks. But if banks are doing well anyways and they continue to run, I'm going to continue to play banks. So that's kind of how I'm digesting this information. It's not like, oh my God, this is the end of the world, Adam. We thought rates were going to go down and now they might, not go down for a bit. That's fine. We do the same thing that we always do, right? We continue to execute based off of what charts say are a probable chance for us to make money. And that's how we do it. Elsewhere in markets, let me see here. The yield on the benchmark 10-year U.S. Treasury note just closed at its highest level since November, settling at 4.657%. Remember, the yield came into this week at just 4.25% and started this year at 3.8%, meaning that the 10-year is now nearing a full price point rise for 2024, as discussed on the Wall Street Lunch podcast. At the same time, the U.S. dollar index has been rallying, with Bespoke Investment Group noting that the greenback and the 10-year yield have been trading in lockstep since last summer. Yeah, the dollar, right, tends to move inverse to the market. So whenever the dollar is rallying, right, the market is dropping more often than not. Because, if the dollar is strong, people want their cash money. And if it's weak, then they want it in stocks and other forms of investments. So that tends to happen. If you weren't aware of that relationship, now you know. So a DXY rallying and the market going down, that's pretty natural movement. But yeah, it's also nothing shocking given the fact that DXY broke a pretty long-standing downtrend in order to do that. Just as SPY broke that uptrend and it's dropped, right? DXY broke that downtrend and it's gone up. And the dollar now finds itself as resistance, while SPY finds itself at support. So we'll see what happens from here. In terms of financials, earnings roundup, all major banks have reported earnings that topped expectations as improved sentiment drove. It's crazy how we're just like, I feel like I might as well write this newsletter. We're all in the same pace here. All major banks have reported earnings that topped expectations as improved sentiment drove a rebound in investment banking and a strong trading performance. It also shows that the corporate earnings story is intact while the banking system seems to be in very good shape, as noted by Seeking Alpha analyst Brian Gilmartin. However, like many post-earnings movements, the trading reaction differed among players. Morgan Stanley and Goldman Sachs both gained as investors cheered on their Q1 results, while things went the other way for JPM, BAC, Citigroup, and Wells Fargo, which is C and WFC. So again, banks really, with their earnings, it's not like huge moves happen because of it. Often, and I don't really ever look to play bank earnings because they don't really move a lot. The ones that go down don't really go down a lot. The ones that go up, they go up, but it's not anything to write home about. So with banks, it's really just continuing to play the technicals and all that. But all major banks have reported earnings that beat expectations, right? So each bank beat on earnings, which is a good sign for continued strength for banks, right? Because they didn't do this and beat earnings based off of interest rates decreasing or anything like that, right? They did that just because of the normal fundamentals that are undergirding how people are moving their money around right now, which is a good sign to say they don't need something like rate cuts in order to continue that success. In terms of global news, fresh sanctions, the U.S. will impose new penalties on Iran's missile and drone program in the coming days, as well as on entities supporting its army and defense ministry. Quote, we anticipate that our allies and partners will soon be following with their own sanctions, said White House National Security Advisor Jake Sullivan, following Tehran's attack on Israel over the weekend. I'm just reading it as I see it, right? Again, this is me trying to be agnostic here. The U.S. House of Representatives has also overwhelmingly voted for legislation that will impose sanctions on Chinese financial institutions involved in buying Iranian crude, but many analysts believe those will not get over the finish line due to worries about boosting prices and angering top buyer China. So fresh sanctions here on Iran, in retaliation to the strike against Israel. In terms of economic news, fiscal sustainability, the International Monetary Fund has boosted its 2024 global growth forecast to 3.2% compared to the previous outlook of 2.9% growth estimated earlier this year. Quote, the strong recent performance of the U.S. reflects robust productivity and employment growth, but also strong demand in an economy that remains overheated, according to the agency. The fiscal stance, this is a quote, the fiscal stance out of line with long-term fiscal sustainability is of particular concern. It raises short-term risks to the disinflation process as well as longer-term fiscal and financial stability risks for the global economy. Something we'll have to give. In terms of today's markets in Asia, Japan were down 1.3%, Hong Kong were flat, China were up 2.1%, India closed. The FTSE in London up 0.5%, Paris up 1.3%, Frankfurt up 0.6%, the Dow up 0.5%, S&P up 0.4%, Nasdaq up 0.3%, crude oil down 0.8%, gold down 0.2%, Bitcoin up 0.7% to just under 63K. Today's economic calendar. Nothing really important. Yeah, nothing really important. What else is happening? We'll wrap up here with our rapid fire stock news rundown. What else, baby? Yellen echoes Biden, U.S. Steel, ticker X, should remain in American hands. So, more merger and acquisition deals falling through the cracks here under this administration. Not even falling through the cracks, just getting struck down. United Airlines, ticker UAL, rallies after strong demand boosts results. ASML bookings miss estimates, demand for EUV machines slip. Report Tesla has delayed some Cybertruck deliveries. Shocker. Rivian skids to new low, but Amazon tie-up may provide backstop. Then Grand Theft Automaker Take-Two announces new layoffs. Learn how to put your money to work. Learn AI. Two biggest things, right? From here until further notice, that is the motto. Trump media DJT keeps slipping despite plans for live streaming. J&J Johnson & Johnson, ticker J&J, sets guidance below consensus as MedTech underperforms. And then is Shopify pitting employees against each other for higher pay? Probably. At this point, it's like, listen, earn your spot because we got a bot right behind you ready to, do exactly what you do, never take breaks and not require benefits or leave or anything else, right? So I wouldn't be surprised if they make it like a Hunger Games, a corporate Hunger Games there within their, business framework. But that'll wrap us up today, right? April 17th, 2024. I'm excited for what the market has for us for the rest of this week. We got Powell yesterday, which is why we got a lot of that, intraday volatility. He went on at around 1 p.m., 1:15, and was speaking and gave some of the remarks that I went over at the beginning of this session. So I'm excited to keep it up. There are a lot of very, very interesting setups here based off of where we go next in the market. A ton of them, right? A plethora of them. Long-term swings, short-term swings. So it's just a matter now of remaining patient, right, and being ready to execute if the opportunities present themselves. So looking forward to that and finishing this week strong, right? It's hump day, baby. Let's make sure that we're out there giving it our best shot and closing the gap between where we are and where we want to be. Everybody have a great rest of the day. I'll see you back here tomorrow morning for our next pre-market prep session. Have a good one.